Now let's take a look at the bigger picture. Matthew Johnson's with us, president, owner, Johnson Wealth and Income Management. I'll start off with that jobs report last week. Of course, we have inflation data coming. We have a lot to talk about. I mean, let's start off with what happened with jobs. I mean, you do see that there are fewer jobs. We did have wage growth, and the Fed basically takes this as the okay to continue to raise rates.
Well, thank you for having me back on, Nicole. Yeah, you know, slow and steady wins the race, except when it comes to the ideology of the Federal Reserve. We have won yet again, where we're starting to see the inflation continuing to go down. We're starting to see softening in the job numbers. This is all the stuff that they told us that they wanted. And yet the big Achilles heel is going to be that of the wage growth. And so I think that this is going to be the ammunition, the data that the Federal Reserve needs in order to justify yet again another rate increase. I'd call this a bait and switch, Nicole, but it's really not, because they're so very transparent. They're telling us, hey, we reserve the right to raise the rates some more. And in June, when they paused the interest rate and then came back out and said, well, that's not exactly a pause. It's just more or less a skip. We were picking up what they were laying down, and we understand that they're probably going to go ahead and raise interest rates, not once, but I would expect 2 more times.
I see. Okay. And I would say a lot of people agree with you that the 2 more times seems to be likely. We heard from Daly, who's actually talking about that the labor market remains really strong. That was a quote. Also, that a couple of more rate hikes are likely to tame inflation. That being said, we're getting a couple of inflation prints. In fact, the expectations for CPI, I'm hearing people are expecting inflation to come down a little bit. It might even be the lowest print of the year, where markets could take off on this. But it's really the PCE that the Fed watches. I mean, I don't know. I think CPI and PPI are very important this week, aren't they?
Oh, of course, they're very, very important. We want to be able to make certain that we're still continuing on with the progress, right? And I think that the expectation is that we could see something really close to 3% coming across the board when we get the data out. However, again, when you mix that core CPI, which has remained very, very strong and very resilient, and you've got the wage growth, again, I think that this is only just going to add fuel to the fire. They're going to use this and say, hey, we've got to get this inflation down faster. I don't want to be critical. I don't want to be a negative Nancy, but I really wish that they would just give it another month and continue to let the market naturally calm down, the economy naturally cool, because I think that it's going to do that without having to beat on these interest rates some more. And this is what's causing me to have somewhat of a very muted outlook for the rest of the year. And I think many investors kind of feel the exact same way, because as the Feds go, so does the economy. And let's face it, it's going to be affecting the market and the earnings.
So that being said, at this point, because you mentioned earnings, and at the end of the week, the earnings start. We'll get a lot of the banks, obviously, that's front and center, names like JP Morgan, Citi, Wells Fargo. But also we'll get Delta, Pepsi. We're kicking it off. I mean, what do you think is going to be the takeaway from this earnings season?
Well, I think we're actually going to be pretty impressed with the earnings when we look at what has been accomplished so far in the first 6 months of the year. I think that there's going to be a lot of good names that are going to show some really good profitability. However, that's not the point. The point is looking forward over the next 6 months, especially if we have to tack on a couple extra rate increases. And now we're up another 50 basis points. What's that going to do for the rest of the year? That's the part that's kind of challenging. And so we have to be very, very careful to look at the numbers. We have to be very careful to listen to what these CEOs are saying. Remember that there's a lot of corporations kind of set their own bar, and so they can look like they're doing really, really well. But we want to be absolutely certain to look at the fundamental numbers and say, okay, how are they really doing? And if we have another 50 basis rate increase, what is that going to do to these corporations that are potentially needing some working capital, but they're really hesitant to borrow any money because of the interest rate environment that we're in right now? That's the reason I'm suggesting we need to stay extremely careful and cautious on corporate earnings and what we expect out of these companies through the remainder of the year.
Yeah. And then what do you tell clients in this environment? I mean, there are some folks who think the soft landing is possible. The recession gets pushed off even into next year. do we even have to have that kind of situation? And does it affect the markets? Do you retest lows, or is the worst of it behind us?
Well, I'm not really sure that we're going to retest lows. I really don't see that there's a strong possibility right now for a recession. I think that we could potentially have that proverbial soft landing. I'd like to think that it's possible. I think that the Federal Reserve, up until this point, has avoided catastrophe. But every time you raise interest rates, you get us a little bit closer to that proverbial cliff, and that's what scares so many of us. However, with that being said, there is several areas of the market, Nicole, that have seen some profound increases in runs on stock. And I want to be careful to reiterate something that is just a fundamental of good investing. And I know it sounds very uncouth. It's very rude to say, but remember that, pigs get fed and hogs get slaughtered. If we have seen a tremendous run in different asset classes or various different stocks that we've got, remember, it's okay to go ahead and pocket those winnings. This is something that we should be able to feel good about. My goodness, I'm up 30%. I should go ahead and trim some of that, put that money in my pocket, and then go out and find another company that is down. And this is how we make money on a repeated basis. But we want to be able to not get greedy, because that always ends up meaning that at some point we're going to give it back.
So you said don't get greedy. You can even take some profits. And then if you have some money that you do want to put to work, where do you put that to work and when?
Well, I think right now that there's a tremendous opportunity, especially with the companies that are still very much cash rich. They've got the liquidity, they're free cash flowing, they got dividends. When we look at those sorts of companies, the staples, we know that those are companies that are going to, if we have a recession, if we're nervous about a recession, we're going to be able to have that dividend income. We're going to be able to be in some good quality companies that are not going to be as fickle. They're not going to be as affected if we have some bad headlines. And I think that this is what we have to be careful of. Remember the people that, had such a terrible time when SVB went down. Those are the people that they saw all the growth, and they just put as much as they could into that banking sector. And those are the people that oftentimes end up getting hurt. So we want to remain diligent. We want to remain stuck on the fundamentals, the free cash flowing companies with the dividends, and be wise with our money.
Right. Matthew Johnson, great to see you. Thank you. Johnson Wealth and Income Management. Thanks so much.